Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Seana Smith alongside Brad Smith, and let's get you the three things that you need to know today.
Good morning, everyone. First up, U.S. stock futures pushing higher today after the S&P 500 suffered its worst intraday sell-off this year amid Friday's rout. Investors are looking ahead to key inflation data out later this week for any signs on progress in the Fed's fight against inflation. The Fed's preferred inflation gauge, core PCE, is expected to cool to the slowest pace since June.
Plus, investors are laser focused on Nvidia earnings out later this week. The AI chip giant's guidance on growth is going to be a key focus here as the company deals with supply challenges with its Blackwell chips and also potentially tighter controls on sales to China.
And finally, Apple gearing up for the impact of Trump's tariffs. The company announcing plans to invest $500 billion in the U.S. over the next 4 years. Apple plans to hire 20,000 workers to produce AI servers as it seeks relief from Trump's tariffs on goods imported from China. The stock market and the reaction here that we're seeing pre-market, Apple shares falling here. Also sticking with AI and data centers, Microsoft has canceled some leases for U.S. data center capacity, according to TD Cowen. The reason for the cancellations is unclear, but TD Cowen suggests it may be due to Microsoft being in an oversupply position or reallocating investment to the U.S. from abroad. U.S. stock futures staging a bit of a recovery pre-market today after the S&P 500 saw its worst intraday sell-off this year in Friday's session. There you're taking a look at some fractional gains across the board here. I was taking a look at the note from the trading floor, our good friend of the show, Michael Reinking over at NYSE, senior market strategist there, and he mentioned that the S&P 500 has proven to be very resilient over the last few weeks, shrugging off a multitude of headlines from Washington. But one thing that they've been focused on as well is the growing level of uncertainty and how that has the potential to stifle economic activity, and that also flowing through to the mindset of investors last week, and we saw that play out.
Yeah, Brad, I think you're exactly right, and the question is whether or not that momentum can continue, whether or not the investors and really the broader market can continue to almost focus on the more rosy side of the picture and able to shrug off some of those concerns. When it comes to what is really going to test some of the market's momentum this week, we don't have to look any further than Nvidia's results. Very much the focus here, not only for the tech trade, but also just the broader market sentiment. Clearly, maybe not carrying as much weight as it has in quarters past, just given the lackluster start to the year, given the fact that there are a lot of unknowns and a lot of headwinds, challenges baked into some of this slowing momentum that we have seen in Nvidia stock, but still very much a bellwether here of AI investment of the tech industry at large. So, of course, that is going to have a big impact here on the broader markets as well.
Yeah, absolutely. The bellwether that we've been waiting for to report earnings, of course, as we've gotten through some of the biggest retail names. And you think back to Walmart and what happened last week, the indicator that we've largely been looking at here in consumer discretionary and consumer staples relative to consumer discretionary as an early warning sign in that relative performance here. That was a major drop that we saw in Walmart last week and really kind of gave us a sense of how much some of the interim plays in the consumer staples and for Walmart, they kind of fall at the center of that within some of their merchandise aisles, but then also the consumer staples within the grocery aisles for Walmart here. And that also led a larger kind of sell-off that we had seen in some of the other retail names too.
Yeah, and also just one of the themes that we have noticed here over the last several weeks is selling on Friday and then almost a relief on Monday if we don't see any worrisome headlines, particularly those coming out of D.C. and kind of on the policy angle. That has clearly spooked the markets in weekends past when you take a look at the fact that we didn't really get anything huge market moving over this weekend. We are seeing a bit of a relief here in the pre-market. All three of the major averages on track to open the week and open the day in the green. So we'll see whether or not we can carry that momentum here into today's trade.
All right. We're also tracking Apple this morning. Apple announced that it will spend and invest more than $500 billion in the U.S. over the next 4 years, including plans to build a new factory and hire around 20,000 workers. Host of Market Domination, Josh Lipton, joins us now here with the story. Hey, Josh.
Brad, that is right. Big news this morning from Apple. The iPhone maker plans to spend and invest more than $500 billion over the next 4 years here in the U.S. CEO Tim Cook saying in a statement, "We are bullish on the future of American innovation, and we're proud to build on our long-standing U.S. investments." Specifically, Apple says it will hire around 20,000 people over the next 4 years. Most are going to be focused on research and development, silicon engineering, software development, and AI and machine learning. Build a new manufacturing facility in Houston that will create thousands of jobs. The 250,000 square foot factory is slated to open, Apple says, in 2026, producing servers to support Apple Intelligence. The company will also double its U.S. advanced manufacturing fund to $10 billion. That fund's expansion includes a multi-billion-dollar commitment from Apple to produce advanced silicon in TSMC's facility in Arizona. Additionally, Apple is going to establish a new academy in Michigan where it says its engineers are going to consult with businesses on implementing AI and smart manufacturing techniques. As Bloomberg notes, all of this is coming just days after President Trump said Tim Cook promised him hundreds of millions of dollars in U.S. investment and that the tech giant's manufacturing would shift from Mexico to the U.S. They don't want to be in the tariffs, Trump said. Now, there is a risk that Apple could be among the companies negatively impacted by fresh trade tensions between the U.S. and China in Trump's second term. Cook is among those American tech leaders who has worked to reestablish or overhaul their relationships with Trump. Following his re-election, he has reportedly traveled to the president's Mar-a-Lago estate in Florida, as has Meta CEO Mark Zuckerberg, Alphabet's Sundar Pichai, and Amazon founder Jeff Bezos. Following this announcement, Trump did thank Cook and Apple in a post on Truth Social, saying the company's investment is based on faith in what we are doing. Seana, back to you.
All right, Josh, thanks so much. Let's continue this conversation here with Apple making the historic investment in the U.S. economy. Tech giant, like Josh said, is going to invest $500 billion in U.S. manufacturing efforts. Here with more on this, we want to bring in Gil Luria. He's the head of technology research at D.A. Davidson. Gil, it's great to have you back here on Yahoo Finance. Let's start with the announcement that we got from Apple here this morning. Is this a smart strategic movement or move here at the right time?
Well, making President Trump happy is always a good strategic move for a CEO of a company who's very much exposed to the types of policies that are going to come from this administration. I would focus less on the bombastic number. Again, this is a number that's made to make a political statement, but more on the fact that some of these investments may actually be incremental. A plant in Houston may be incremental. The overall number likely includes, for the sake of conversation, cost of goods sold, SG&A, et cetera. It's probably not incremental CapEx. That's more political. But there may actually be some domestic investment that is incremental that was not previously planned, so the company can get in good graces with the president.
How should investors evaluate this, especially as the upfront dollar figure would lead to the question of when does that flow through to some of the financial performance for the company?
Given how big Apple is, I wouldn't expect these investments to change the economics of the business very much, especially not over time, especially given how long it takes to open a plant. And I would just focus more on the fact that if it's aligned with the president, with this administration, it's less likely to get ensnared in the U.S.-China conflict, which is really the primary goal for CEO Cook, is to not be a victim of China raising tariffs, of the U.S. raising tariffs on imports from China. They don't want to be in the middle of that.
Gil, what about, does this signal anything about how Apple is approaching just manufacturing overall in China?
Apple has already started diversifying away from China a while ago. It will continue to do so. If the focus is India, the focus can also be the U.S. The difference in manufacturing between China and the U.S. isn't what it was 20, 30 years ago. It isn't even where it was 10 or 15 years ago. And so it does make sense for Apple to diversify away from China, take as much production out of there. And if it can move it to the U.S. in an economic way, that is a prudent decision, especially if we do have a regime of higher tariffs overall. The more you manufacture in the U.S., the more you're insulated from that.
And so all these announcements considered, I mean, we've seen, it seems like major dollar figure CapEx rollouts over the start of the year and even going into the last earnings period as well here. How do you kind of look through these and then ultimately for investors who are trying to figure out how Apple and the exposure that they also have to any tense relationships between the US and China, how that also plays out too, because there is a significant revenue exposure in that region.
Yeah, China is Apple's most difficult market. It's the most competitive and dynamic market. They have a lot of very strong domestic competitors. They don't have their full suite of AI products rolled out there yet. So it's already become a much smaller part of the business than it used to be, and it's not going to get any easier. That is why they have to invest elsewhere and try to grow other markets. Again, India is a promising market, but they also have an opportunity to roll out Apple Intelligence globally and have that support the growth. In terms of CapEx, let's not forget Apple has chosen a much lighter model than some of the other mega caps. A lot of their AI is going to be done on the phone. It's going to be done on the Mac. They're not necessarily building as much data center capacity as your Microsoft, Google, Amazon, and Meta. And that actually gives them an advantage in terms of how adaptive they can be to where AI is headed.
Okay, let's talk about one of the competitors out there, and that's Microsoft, TD Cowen, or maybe not so much competitor, but more broadly speaking, when we talk about big tech and some of the movement that we are seeing in regards to AI. TD Cowen was out saying that Microsoft has dropped some of its AI data center leases. I'm curious from your perspective whether or not that is true, but the fact that that line of thinking is out there right now, what are the implications of that?
Yeah, very broad implications. Microsoft, let's not forget, is the one that started the great data center build out. They invested early in OpenAI, and when ChatGPT broke through at the end of 2022, Microsoft started accelerating its CapEx faster than anybody else. They got the biggest allocation of chips from Nvidia and more than doubled its spend, even as a part of revenue since then. What they're telling us now, and Satya Nadella has been pretty consistent over the last few months, is that maybe they've gotten to a level that they can just sustain and plateau at. They just spent a lot in the fourth quarter, the fourth calendar quarter, but they said for the next couple of quarters, their spend is going to be flat. And then in their next fiscal year, they're going to grow CapEx less. So it makes sense that they're reevaluating the portfolio of investments and starting to moderate it. That will then cause other mega caps, especially the hyperscalers, to reconsider their plans. Right now, Amazon's still talking about increasing their spend this year. Google's talking about increasing their spend this year. But we already heard Amazon say, we're only going to stay flat from where we were in Q4. So the signaling is happening that the data center build out is moderating, at least from the hyperscalers.
So then, Gil, I guess more broadly speaking, then what's the ultimate takeaway then on demand and what that demand picture looks like?
Well, if you're starting to look at Nvidia, who's reporting Wednesday after the close, this year is going to be great. The fourth quarter will absolutely be a huge record, and the rest of this year is pretty secure in terms of what their largest customers are going to spend. It's really next year that you have to start thinking about. If Microsoft is plateauing, if Amazon's plateauing, if Google starts talking about that later this year, Meta may start talking about the fact that they're at a good run rate, then we may not be able to deliver the growth investors are expecting for next year.
We already know that the long Mag 7 trade is the most overcrowded trade that's out there right now, and Nvidia set to report earnings, as you mentioned a moment ago. This could perhaps make the thesis further, though, for the larger AI narrative and add more fuel to the fire here. But just how much more fuel is there, you think, in that trade?
So we've already seen a rotation, right? The early winners from AI were Nvidia and Microsoft, and up until the middle of 2024, those are also the stocks that performed the best. We've already started rotating into more software-oriented companies, the companies that will actually build these solutions. And especially, we like the software infrastructure companies, Snowflake, Datadog, JFrog, companies that build the tools that make it possible for applications in AI to be delivered. That's where the puck is headed. And when those tools are robust and when these applications start getting built, then those application software companies will benefit. That's probably 1, 2, 3 years down the road.
Gil, always a pleasure to get some of your insights. Thanks so much for joining us here this morning.
Thank you.
Coming up on Morning Brief, everyone, we count you down to the opening bell on Wall Street. Plus, we break down Warren Buffett's latest shareholder letter as the Oracle of Omaha increases his cash holdings. And we'll have more coverage on Nvidia ahead as investors gear up for earnings. We'll discuss that and much more on Morning Brief. Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, we got to talk about Alibaba here, about to invest $53 billion in AI infrastructure over the next 3 years. That's more than the company has spent on cloud and AI over the past 10 years. The Chinese online retailer says the spending, quote, underscores the company's focus on AI-driven growth and its role as a leading global cloud provider. Shares, they are down by about 5.3% here going into the start of trading activity here. But the planned spending here, it also on AI infrastructure matches half of the initial $100 billion investment Stargate AI plan promoted by the U.S. here too. So all these things considered, Alibaba and the leadership team have made some significant commitments trying to appease both investors and the AI build out, but as well trying to please some of the geopolitical counterparts too.
Yeah, certainly. And this is on the back of some of the commentary that we got on the earnings call last week, where Eddie Wu very much doubled down talking about the opportunity that lies ahead when it comes to AI. AI certainly overtaking that earnings call. I think that was a big takeaway from analysts last week. And we certainly saw that reaction play out in the stock moves last week. A lot of that excitement. But when it comes to the degree and how significant this spending is, the 3-year CapEx plan is 39% higher than the total spending here from Alibaba in the past 10 years. So we talk about the plan to spend more and more on technology, spend more and more on AI. Alibaba very much following through in the footsteps of some of the larger tech giants here in the U.S., just in terms of what they're seeing demand-wise, what they're seeing opportunity-wise. We know Eddie Wu in the past has said that more cloud growth seen in the next 3 years than in the last decade. A lot of that being driven by that growth opportunity there. So very much we have seen that excitement surrounding the stock over the last 2-year chart, where you're still looking at some losses there. But again, when you take a look at the fact that we have seen much of that excitement return to the stock here most recently, especially in the heels of the earnings results just last week. No surprise that they are then further doubling down on this. Although when you take into account more CapEx spend, we are seeing the shares under a bit of pressure here this morning. But again, that excitement, though, I think more so for that longer term opportunity. Yeah,
this is a major investment, especially as they're looking to achieve their first quarter of profitability for their AI data center within the next fiscal year here. So trying to supercharge some of that ability as well.
Yeah, year-to-date gains of just about 71%. All right, let's take a look at Robinhood, another stock that's actually done very, very well here over most recent weeks. But the SEC is dropping its investigation into the company's crypto business and has no intention of moving forward with an enforcement action. This comes days after Coinbase announced that the SEC did agree to end its enforcement case against it. You're looking at shares pop just about 1.5%. This is a stock that has done tremendously well since Trump was elected here as president. Take a look at some of those gains. The stock up just about 160%. Yes, it is coming off its worst week that we've seen since December of 2021, but putting it into more broader context of the gains that we've seen since the November 5th election, we are still looking at a jump of just about 160%. This, of course, the news out that we're getting this morning, removing another potential overhang here on the stock moving forward. And I think it's fair to say overall, the street very optimistic maybe about some of the developments that we could see come from Washington, come from the White House, the new administration here in regards to crypto and what that looks like, a more favorable administration.
Yeah, just think back to how they talked about this on the earnings call as well here, saying that in January of this year, net deposits were their second highest month ever. Equities, options, crypto trading volumes were all up double to triple digit growth rates from a year ago. In fact, they went on to say January option volumes all-time highs there. And so all of these things considered, you think back to the margin balances as well here, and the balances for customers who are using the platform, continuing to put even more into those accounts, funding their accounts, and then even for what it means for Robinhood, how many of them are opting into that gold and premium tier as well? I think it was somewhere around 2.6, 2.7 million gold paying subscribers here. I'm going back to my notes here from a couple weeks back, but all those things considered for Robinhood in their growth trajectory, trying to extract even more of the average revenue per user because of that gold. And then additionally, looking across some of where they're looking at the tokenization of private assets as well, that's a major boon to the business in the future that they're thinking through as well at this juncture. We're seeing shares higher pre-market, 1.6%. Also here, we got to talk about the Oracle of Omaha. Warren Buffett released his annual letter to Berkshire Hathaway shareholders saying, quote, in 2024, Berkshire did better than I expected, though 53% of their 189 operating businesses reported a decline in earnings. Berkshire's cash holdings came in at just over $334 billion, nearly double the $167.6 billion reported in 2023. Joining us now to break down the biggest takeaways from the letter, we've got Kathy Seifert, CFRA Research, VP of Equity Research. Kathy, great to have you back on the program with us. Why is Buffett sitting on such a major cash pile here?
Well, I think we can glean a couple of messages from that annual, the annual report. And, he's sitting on cash because he doesn't think he has a good alternative to deploy it. Coupled with the fact that Treasury yields ticked back up. One of the reasons that Berkshire's numbers outperformed my estimates, which were like 10% above the consensus, was that investment income was significantly better than people were expecting. And insurance, the personal lines insurance turned around. So, the bar with Treasury yields where they are, the bar to look for alternatives is higher. And then, combined with the fact that equity valuations are certainly not where a value investor like Warren Buffett would like them to be. I think it's no coincidence that he's focusing on his Japan investments. I mean, he made those 5 years ago. I think he's, if he does a deal, he may look abroad where valuations might be a little more attractive.
Kathy, talk to me a little bit more about that and kind of what you think the line of thinking there, just given the fact that he says that there is still a dearth of opportunities here in the U.S.
I'm sorry. In terms of what specifically, the landscape for acquisitions?
Yeah, if you were to put some of this money to work, I think the big question for investors is what is it going to take to get them off the sidelines? What it's going to take to get them excited about that next investment? What do you think his line of thinking is?
I mean, my sense is he's thinking that the economy in 2025, there's a lot of uncertainty. And I think there are a lot of people who share that view. I mean, the macro picture, the geopolitical picture has a lot of uncertainty, makes it very difficult to plan. And you've got equity valuations that, quite frankly, I think there are a number of us in this business that are a little surprised at how well they've held up, given all the risk, largely, stemming out of some of the actions in Washington. The other thing with Berkshire, too, though, to remember is 2025, they are going to be paying out at least $1.3 billion in wildfire claims. I think a lot of that's going to come from their reinsurance business. That number could grow. They have historically made estimates that end up being, lifted upward. But, if you look at typically where Buffett tends to make his outright purchases, he tends to have an equity portfolio barbelled between technology and financial, and that's barbelled largely because of the Apple position. And so his outright investments tend to be in energy, utility, consumer staples, insurance. I mean, I wouldn't be surprised if he decides to add on to some of his insurance franchises potentially. But if you look at the other areas where he tends to go into, the outlook is pretty uncertain. So it'll probably pay for him to wait. Historically, it has, and that's probably going to play out similarly this year.
And Kathy, just talking big picture here, because I think that's what a lot of investors like to glean from this, some of his commentary. What does it ultimately tell us just about market conditions then in the new year, and maybe what some of that volatility could potentially look like?
I think a lot of the volatility or how things are going to play out will really depend on the degree to which mass deportations ratchet up inflation, tariffs ratchet up inflation. And, Berkshire's biggest business is in insurance and reinsurance. And both of those policies are inflationary to the insurance business. So his core operating businesses are, sort of staring down the barrel of a gun with, potential threats to your operating margins. So, and then there's geopolitical risk. I think against that backdrop, he's probably going to stand pat and, coupled with the fact that he's being paid to wait.
All right, Kathy, always great to get your insights. Thanks so much for taking the time to join us here today.
Thanks.
Keep it right here on Yahoo Finance. Much more of your market action ahead. We've got the opening bell for you when we come back.
There you're taking a live look at the opening bell on Wall Street and in Midtown Manhattan at the NASDAQ, where you've got Power Solutions International ringing the opening bell, PSI and some funfetti. And you've got Home Trust ringing the opening bell at the New York Stock Exchange. We are off into the races on this final full trading week of February. My gosh, folks, here we are. All right, taking a look at where we begin today's trading activity as we're taking a look at the Dow Jones Industrial Average. Let's populate this chart here for you and just give you a look at where the line graph is. There we are. All right, over the past 3 days, we've seen some slippage in the Dow, down by about 2.3%. Let's put this on a 5-day view so you could see the context of last week's move, 2.1% lower. Here today, out the gate, we are higher by about 0.3%. NASDAQ Composite, same there on a percentage basis, up by about 0.3%. However, the slippage late last week. As of right now, for the S&P 500, you're also seeing some gains over the course of the early trading seconds here that we have, up by about 0.3%. That's where we begin the trading activity, but coming off of last week's decline here that you saw of a little more than 1.3% over that past 5 days, according to the chart that we have up here. Ultimately, taking a look at some of the sector activity as well out of the gate. We'll get back to that NASDAQ board here, but more gainers than decliners here. Staples pulling up the caboose right now. That's down by about 0.3%. But taking a look at communication services, we begin the day higher by about 0.6% there. Like we said a moment ago here, more gainers than laggards right now for the 11 S&P 500 sectors. And digging into technology to start off today's activity, and want to take a look at a few key players here. Of course, the big earnings story of the week is going to be Nvidia. We're going to get that on the 26th. And taking a look at Nvidia shares here this morning, they're up by about 2.4%. However, some slippage that we have seen over the course of a few trading sessions here, and for Palantir, it continues. It's down right now, and it's breached back below that $100 level here. We are sitting right now lower by about 5.6% to start off today's trading activity. Just to get you a little bit more context on the move that we've seen over the past 5 days. If this chart would like to populate for me here, okay, it's not going to want to. But ultimately, over the past 5 days, I believe it's slippage of about 15%, just shy of that we have been tracking here very closely here. And then just lastly, we'll take a look at the Dow 30 components here. As we see mostly green here on the screen, there are some spots of red, but we'll kind of zero in on some of the mega cap tech stocks that are in the Dow at least, and you're seeing mostly green there. Walmart continues some slippage after its earnings last week. And ultimately saw that move lower here, and this is where you could see that earnings move plus today's activity moving it lower by about 0.5% here, down 9% over the past 5 days. Seana, I'll toss it back over to you.
All right, Bradley. Well, let's talk about today's strategy sessions. Now time to dig into some of the moves that we're seeing here right at the open. U.S. stocks are rebounding today, coming off the S&P's worst sell-off this year in Friday's trade. However, the benchmark index has gone 35 trading sessions without back-to-back losses of 1%. So will the dip buyers return today and keep that momentum going? We want to bring in Michael O'Rourke. He's Jones Trading Chief Market Strategist. Michael, it's great to have you back here on the program. It certainly looks like the dip buyers are back. What are you gleaning from the early action that we're seeing this morning?
Yeah, I do think they're back today, but it's still early. I think Friday definitely spooked a lot of people. as far as the economic data we received. There were dip buyers, I think, in the market Friday. There was some nice ETF inflows in the S&P 500 spiders and the other S&P ETFs, S&P 500 ETFs. But the volatility we saw Friday is something we haven't seen in quite some time. So it'll be interesting to see how this week plays out, especially with Nvidia's earnings later in the week.
So do you think it's safe to buy this dip going into Nvidia's earnings?
It's not that much of a dip, so that would be my concern. We hit all-time highs last week. I think it was Wednesday. Yep. So I think there's still a risk here that there's going to be more volatility that has to play out. And what you're seeing here is some of the names that have led the recent rally, whether it's Palantir, obviously some of the Mag 7 names. Nvidia had a massive bounce coming off of its DeepSeek lows. That you've seen some narrow leadership push us to those all-record highs. So I think we're due for at least some consolidation here. And I think you're going to see investors, while they'll buy the sharp downward moves like we saw Friday, I think if we see more of a slow leak or consolidation, I think you'll see people take a step back.
Michael, do you think Wall Street's a little bit too quick to dismiss some of the concerns still surrounding tariffs? And I guess what kind of volatility that could further introduce here in the weeks ahead?
Well, I think, it's funny when you guys were talking about the Robinhood new accounts and the big boost in their business earlier in the segment, that just highlights the way everyone's felt about the election, right? Since November, everyone's really piled into the market. Everyone's been very bullish, very optimistic. And I think, we have a long way to go for all these optimistic Trump policies to come into shape. It's one of those things where you do have to break some eggs to make an omelet. And I think we're going to be in the egg breaking stage for the next, 6 months to a year. So while we've had this early euphoria for the past 3 months or so, I think you're going to start to see that fade in the coming weeks and months as we try to see whether it's tariffs and other measures the administration's taking while the market has to really digest those to see real progress somewhere down the line.
Well, for the price of eggs right now, it better be one damn good omelet, Michael. Ultimately, as we're thinking about moving forward from here, any type of recalculation that we're expecting off of this earnings period for the full year growth estimates as well here, have you seen that start to play out as we typically get some of those revisions early on, companies starting to step back off of some of the more aggressive outlooks that they have?
Well, yeah, I mean, I think you could definitely characterize this earnings season that's basically ending right now as somewhat disappointing. We're still looking at a good growth environment overall, but as we know, it's very top heavy, very much driven by the Mag 7. Obviously, the biggest driver of earnings growth the past couple of years has been Nvidia. So their report's going to be that much more important. But you're also looking at a situation where the Mag 7 is twice as expensive as the other 493 names in the S&P 500 together. So a big trend we've seen since, I'm going to say since Christmas, but especially since the beginning of the year, has been investors being a little more defensive, rotating into those other 493 names or the S&P 500 x the Mag 7, while you see the Mag 7 names consolidate a little bit. So like I said, I think we see those earnings growth numbers start to moderate here, but it's still expected to be a positive earnings year for the market.
Michael, I guess put NVIDIA's results into a little bit better context for the viewer here. How significant are the results that are coming out later this week in comparison to prior quarters? Does it still hold that same weight?
I think it does. Obviously, NVIDIA has been the best. It has had one of the most remarkable ascents in the U.S. stock market because its business has grown fundamentally that well and that strong. From being a company that was doing, $15, $20 billion in revenue is going to do $120 billion in revenues in the matter of years, a couple of years. So that type of growth is really important going forward here. Now, of course, those growth rates are going to moderate, so that's important. But that type of change, that's why it grew to become the largest stock in the world or largest market cap in the world. So it makes it very important. And of course, it's the cornerstone of the AI trade, right? Every major corporation is investing tens of billions, and especially hundreds of billions over the next couple of years into AI. And thus far, NVIDIA has been the primary beneficiary of that through their GPU sales. So again, it really is the pulse of where the growth is in the tech economy, which in a lot of cases is the U.S. economy at this point, and especially where the stock market earnings are and earnings growth is going forward. So I think it's as important as ever, basically.
Michael, thanks so much for taking the time here just after the opening bell. Appreciate it.
Thank you.
It's time now for our chart of the day. Let's send it on over to Catalyst co-host Madison Mills for a look at the S&P 500's moves here. Hey, Maddie.
Hey, Brad, thanks so much. So it's really interesting to see the kind of bullish lean of this market, just biased towards optimism. We've had 35 trading sessions without a back-to-back drop of 1% so far this year, and that is the longest streak of moves in the S&P 500 to the upside without that back-to-back drop of 1% since last December. And over the past year, that's only happened 3 times. And this is interesting in the context of incoming policy from the Trump administration around tariffs in particular. This kind of known unknown in the market that's led to a lot of frustration and questions, but not an actual kind of drawdown in the market. Again, that bias towards optimism here. There are, however, signs that as investors continue to buy the dip, there is a question mark in the air. Steve Cohen saying, quote, negative for the first time in a while because of tariffs. Ken Griffin also having some bearish commentary on tariffs in the past week. And even Warren Buffett, of course, talking about some of the risks in the market here. I lastly just want to mention that while the broader index has moved to the upside here, the average S&P 500 stock has fallen as much as 9% this year. And Kevin Gordon over at Charles Schwab indicates that that could be indicative of a churn in the market, kind of some duck paddling under the surface despite smooth sailing above the water here, guys.
All right, Maddie, thanks so much for breaking that down. Well, with Nvidia coming up later this week, the company's earnings reports are going to be a huge focus here for Wall Street. Analysts expecting double-digit growth for both adjusted earnings per share and for revenue. Investors are waiting to hear what CEO Jensen Huang has to say about the environment for AI chip demand and potential rising competition in the space from China's DeepSeek. Yahoo Finance hit the streets of New York to ask everyday investors about how they're deploying their cash and whether or not Nvidia is part of their portfolio.
I hold about 25 different stocks.
Currently, I like to invest in a lot of AI.
AI is the future.
With the rising AI.
I don't own Nvidia. I just haven't invested in specifically because I felt like I missed out on the wave.
No, I'm not invested in Nvidia. I haven't really followed the hype train too much on it.
To be honest, I don't keep too much track of Nvidia at this point.
I only owned Nvidia shares as part of like an ETF or a mutual fund. If it were 10 years ago and the price were a lot lower, I would have bought a lot of individual shares of Nvidia.
If I had the money, I would definitely invest in Nvidia.
I have some Nvidia, but I sold most of it. I thought that my money could be like better spent somewhere else. If I had more money, I would buy more Nvidia.
I like Nvidia a lot. It did become one of my top stocks. I bought into it a long time ago around COVID, and then I just got super lucky. I wouldn't buy any more Nvidia, so the price is a little too high for me.
I bought shares last year when they were, well, maybe not the best time because they were really high. I do follow the earnings reports of Nvidia. I think it's definitely going to be positive.
Oil prices slightly higher here this morning with the price of a West Texas intermediate WTI here briefly dipped below $70 a barrel. You're now seeing gains of just about 0.1%. The move here are largely driven by some of the geopolitical uncertainty, supply risks. You have ING analysts citing a potential Russia-Ukraine peace deal and speculation about OPEC Plus production. Here with more is Ines Ferré. Ines.
Yeah, Seana, and we have seen various factors that are playing into the price of oil today, as you just mentioned. Of course, tariff uncertainty has really weighed on oil prices, has kept it sort of range bound for the month of February. But just to show you what we're seeing right now, we are seeing a slight move to the upside. As you mentioned, a push for a peace deal in Ukraine. This would normally move oil prices a lot lower, but I just got off the phone with an analyst that told me, look, the expectation is that sanctions, if there were a peace deal between Ukraine and Russia, sanctions against Russia would be lifted. But traders are saying that that oil is already hitting the market. So that's why you're not seeing a big move in oil prices. You also have Iraq that may add more supply into the market. And then you've got the expectations that OPEC Plus is going to once again delay its output. It's introducing more barrels into the market. This would be the fourth delay for OPEC Plus. So traders are definitely looking at that and saying that there is a oversupply concern. There is one bullish factor for oil, and that is if the U.S. were to decide to refill its strategic reserve, that would more or less hold a floor price on oil. I do also want to note what's been happening with natural gas prices, because we have been seeing those tumbling down more than 6%. You've got warmer weather that's coming. There were some frozen wells. Now those are unfreezing, and those wells are coming back online sooner than expected. So you could see natural gas production at its peak levels once again by the end of the week, guys.
Ines, thanks so much. Great context there. Appreciate it.
Thank you.
All your markets action ahead. Stay tuned. You're watching Morning Brief. We're taking a closer look at some trending tickers this morning. We're doing it in 30 seconds each. Let's go. First up, Nike upgraded to buy from hold at Jefferies. The price target lifted to $115 a share. That's from $75 a share, implying 50% upside from the Friday close. Jefferies is bullish on a strong recovery over the next 2 years. The analyst sees CEO Elliott Hill prioritizing the restoration of wholesale partnerships and driving innovations. The firm also noting job listings for product positions are up so far this year versus the prior year. Quote, "We think Hill has the right playbook." The analyst also says Nike Skims will, quote, revolutionize the activewear market. Shares are up 5%.
Let's take a look at Block. It was boosted to outperform from market perform at BMO. Now the analysts there are seeing an attractive buying opportunity following the recent underperformance. Shares are down more than 25% over the last 3 months. Now BMO's new price target implies a 30% upside as of Friday's close. The firm citing stronger profit growth for Square and also Cash App expected in the second half of 2025 as some catalysts here for the stock moving forward.
And finally, Twilio raised to overweight from equal weight at Morgan Stanley with a new price target of $160, up from $144 a share. That is a 40% increase from the stock's last close. The analyst says post-earnings sell-off was overdone, and the stock has fallen more than 20% since reporting Q4 results. The firm says that they are increasingly confident in Twilio's ability to execute growth margin reacceleration here. So those are some of the stocks that we're watching. But you know what? Since we've got some time and we're mic'd up and here on set already, let's go back to that Nike note for a hot second here, because some of the major things that they're also calling out within this playbook here also gave us some timing in the recovery that they're looking for. They're looking for a fiscal year 2027 V-shaped recovery here. Nike turning back on an innovation engine, inventory levels for their channels being rebalanced, and wholesale distribution, distro as they call it, being increasingly setting the stage for accelerating unit volumes and healthier full price sell-through. If you've been tracking at home, for Nike, what they've been talking about, the optimal scenario for them is this marker of selling somewhere around 65 to 70% of their product at full price. Now, it becomes harder to manage how much of that is sold at full price when you go through some of the wholesale and retail partnerships, because they have more of a need to get some of that inventory off of the shelves or off of the site so that they could bring in the new seasons of inventory that they're already in those purchasing conversations around as well.
Yeah, they talk about job listings, the fact that there's more job listings now for product, obviously really showing that that is an emphasis and a priority here for Elliott Hill. They talked about the fact that looking back 10 years ago, clearly the playbook worked then. They don't see it changing this time around. Very optimistic of that. The new deal that they announced with Skims, Nike Skims, are saying, quote, set to revolutionize the activewear market. So there is a lot to like within some of the changes that have already been made under Elliott Hill. And that very much seems to be just the thesis of this, the fact that we are seeing this return, obviously, to a focus on the the product pipeline and ultimately what that is going to potentially do to drive some of those future sales. All right, well, that does it for a morning brief, but keep it right here on Yahoo. Finance Catalyst is coming up next.